All right, welcome to another episode of the Market Disruptor Show. I am here with founder and CEO of BlockFi, Zach Prince. And BlockFi is one of the fast-growing, maybe leaders in this crypto lending space. We've been talking about recently about the decentralized finance, talking about velocity of money, unlocking capital, things like that. And they're right in the space. And we're going to dig in, ask him the questions that you should be asking if you could. And so anyway, welcome to the show, Zach.
Hey, Mark. Thanks for having me.
Yeah, so we had some conversations before, and you were kind of telling me a little bit how you got here with crypto and into this company. And there's really some intersections with what I talk about a lot. So give us a little bit of background on who you are and how you got here.
Yeah, sure. So first off, thanks for having me. I was telling you right before we hit record that I'm a big fan of the content that you're putting out there. My background is that I've always worked in venture-backed technology companies, and most recently, prior to starting BlockFi, I was in the online lending sector at one company that aggregated data for institutional investors across all of these different online lending platforms. And a lot of these platforms offered an option for retail participation on the platform. So you could invest in consumer loans or commercial real estate loans or invoice receivables. And I was also tracking other parts of fintech like robo-advisors and things of that nature. And all my friends were asking me about it, all the time, basically. And so I started a little blog on the side in 2014, and that's what led me to cryptocurrency. Bought my first Bitcoin at the end of 2014, found Ethereum early 2016. And then on the velocity of money topic, I was actually in early 2017 planning on buying a property in Texas that was going to be a rental property. And obviously at that point in time, cryptocurrency prices had gone up a fair amount, and I was feeling really proud of myself for having made that investment. Yeah. And I was curious what the bank would think about those assets and whether they would prescribe any value to them in terms of their underwriting decision. And so I included Bitcoin and Ether as line items on my financial statement that I submitted to a bank that I was applying for a loan for to buy this property. Not only did they say we think of these as a big fat zero in terms of how much they're worth, but they also said, well, we're going to have to put you through some extra compliance checks now. We think you might be involved in some illicit activity, that type of stuff, because there was a lot less awareness about these types of assets back then than there is now. And that was when I had a light bulb moment for BlockFi. And basically the idea was that cryptocurrency was going to continue to be a growing asset class. I started believing tremendously in some of the value propositions that these assets have in terms of privacy, in terms of global access to venture capital like returns, or just novel assets that could appreciate a lot in value, and eventually decided to start a company around that idea in the summer of 2017, and that's BlockFi. We first started as a platform where you could borrow money supported by the value that you had in cryptocurrency, so kind of checking that box that traditional banks don't check. And we've expanded, both the products and services that we offer since then, and also our vision for what we think the company can become over time.
Now, you came from, like you said, fintech, financial technology, and you were working in the peer-to-peer lending space. And did you transition straight from that into BlockFi?
Yes. So okay. I worked at two different companies in that space. One, Orchard, where we were a data aggregator and technology provider to institutional investors that were buying loans or lending directly to all of the major platforms, Lending Club, SoFi, Prosper, Funding Circle, et cetera. I think we had around 200 different online lenders in our database and on our system. And then our institutional clients were banks, large credit funds, large family offices, all different types of institutional capital that were buying loans from those places. Yeah. And then I also spent about 2 years at a consumer lender called Zibby that finances large ticket retail purchases at the point of sale for individuals who have low FICO scores or no FICO score because they're not a U.S. citizen, that type of thing, and then started BlockFi.
Do you think this disrupts the peer-to-peer lending space?
I think that there are learnings from peer-to-peer lending that can be applied to building businesses in the cryptocurrency lending space. But I think it's pretty different. So a lot of the things that happened in the peer-to-peer lending world were based on credit scores or financing different assets like real estate or invoices or equipment. So I actually think that structurally it's more comparable to like brokerage lending. So margin lending or liquidity access lines from the public equities world than it is analogous to peer-to-peer lending structurally.
I'm not super familiar with peer-to-peer lending markets, as I haven't been an active user. I'm aware of it. I've done research on it. I know how big it is, and even in other countries, like in China, it got really big and got kind of ahead of itself. But when you have companies that are kind of centrally controlling that, are you really doing peer-to-peer, like person-to-person, and someone's in the middle managing that, or is it really kind of not so? It's more like portfolio lending or something?
I think it depends a little bit on the implementation from the platform. So, for example, like on Lending Club, which is the largest peer-to-peer lending platform in the US, currently only about 10% of the loans that Lending Club makes are financed peer-to-peer, meaning there's a retail individual on the other end who's providing the capital that goes towards making that loan. And it's completely centralized in the sense that Lending Club is always making the loan from a regulatory perspective. Lending Club is controlling the decision about who gets approved for a loan and at what price. And then there's other types of peer-to-peer lending implementations that are different variations on that same theme.
Yeah, I was just curious how this model kind of fits, because obviously with BlockFi I could loan or borrow, but it's not peer-to-peer, right? So I'm kind of going in with the company, and then the company's kind of acting. So I guess it's similar to what the P2P industry is doing. But the good piece of it, which is, I constantly state, how the importance of being an investor, because we need those returns. And with P2P or what you guys are doing, you're really giving people the option to loan, to make money, right? Above average interest.
Yeah, that's exactly right. I mean, the exciting thing about peer-to-peer lending and about one of BlockFi's products that enables you to earn interest on your crypto holdings is that it's a channel to make more money that didn't necessarily exist before. The things that people got excited about from the peer-to-peer lending sector were the opportunities for portfolio diversification and income generation, and the ability to access those, even with a $1,000 or $5,000 or $10,000 investment, and that simply just didn't exist before that industry came around.
Yeah. Now, BlockFi kind of has two different products in a sense, right? Where either one, I could borrow money against my crypto holdings, or two, I could just park them and receive like above average, above market interest or something like that. Is that right?
That's exactly right. So if you have Bitcoin or Ether, you can open up a BlockFi account and earn interest the same way that you earn interest in a savings account from a bank, except without like FDIC insurance and some of those like banking protections that exist from the federal government.
Right.
But you earn interest in the asset that you've deposited. The interest is paid every month, and once the interest is paid to you, it becomes part of your balance, and therefore you're earning compound interest on the balances that you hold with BlockFi. At the same time, you have the ability to borrow US dollars against the value of that cryptocurrency that you have with BlockFi at rates as low as 4.5% per year. And when we do that, those loans are structured as interest-only loans. So if you borrow $10,000 at 4.5% a year, your monthly payment would be $450 divided by 12. And then you can pay back the principal either at the end of that term or at a later date. And the reason I mention that structure is because for certain types of investing, specifically cash flow type investing and some of the velocity of money arbitrage that you talk about in one of your other videos where you're borrowing at 4 and investing in something that earns 10, that interest-only repayment structure can be really valuable in terms of getting incremental leverage from the cash flow that you're producing.
Mm-hmm. Yeah. So for those of you on the podcast that maybe haven't watched the videos, we're talking about a concept of velocity of money where $1 can do multiple jobs. So I can put it into one account and pull it back out while it's still parked there earning interest, and then put it to another job. So for example, I could take my crypto, I could take my Bitcoin that has gone up 150% this year, and I could borrow against it. I'm paying 4% annually or 4.5% annually, but hopefully making 100% annually. And then I can redeploy that money into now another asset. So for example, a piece of real estate, like Zach, you mentioned in Texas, I could put into a piece of real estate. Now that hopefully I'm making 7, 8, 10% on that. So now that $1 is doing multiple jobs. So catching you guys up on the velocity of money. Now, I love that concept. I always say Warren Buffett said, right, if we don't learn how to make money when we sleep, we'll work till the day that we die. So it's all about putting that money to work. And hodling makes perfect sense because of because crypto is all about investing into a technology that needs to be developed. It's going to take years. So we want to hodl, but being able to unlock that value is important. So you have those two different products. Who are the people that would want either one of those products? And who do you typically see coming in? Is that like institutions? Is that retail people? Like, what do you see?
Yeah, great question. So we think of our core client as being retail. So it's primarily individuals. We do have some small corporates that are also clients. So for example, a company that did an ICO and holds some crypto on their balance sheet, or mining operations, we also have as clients. But the platform is really built for retail, and we think of retail as being our core customer. There are things that we do in the institutional market to facilitate the products that we're delivering to our core retail client. So for example, when we're lending dollars at 4.5%, that capital is coming from an institutional lending facility that BlockFi has. When we're paying interest on Bitcoin or Ether deposits, the interest is generated by BlockFi lending Bitcoin or Ether to institutional borrowers. But we think of those functions as being things that enable the delivery of the products to our core retail customer. And we have customers primarily in the U.S. today. So about 75% of our client base is here in the United States, and 25% outside the U.S.
Now, is it because that you're more retail focused? I think on your terms, do you pay like less interest on larger balances, right? So like smaller accounts get more and larger accounts get less. Is that right?
That's correct.
It doesn't seem right. It seems like I should be getting more for larger balances.
Yeah, and in traditional markets, you absolutely do. The differences about the cryptocurrency market right now that drive that are that the market to borrow cryptocurrency is nascent and undeveloped, and there's not a risk-free rate of return that exists on Bitcoin the same way that there is on a fiat currency. So when we initially launched the product that enables you to earn interest publicly in March, we saw an influx of deposits. And in general right now, if you just looked at the entire market of cryptocurrency and said, okay, how many people are interested in earning interest and how many are interested in borrowing, you would have an imbalance there where there's a lot more interest in earning the interest than there is interest in borrowing in that asset, at least today, because the market's still nascent. So the reason we implemented that structure is that we wanted to be able to offer an attractive interest rate to as many unique customers as possible, and put a little bit of a gating factor on how attractive this was to institutions or to particularly large holders of cryptocurrency. But the limits right now are still pretty high from a retail perspective. So for example, on Bitcoin, you earn a 6% interest rate on a deposit of up to 25 Bitcoin, which at current prices is right around just under $250,000 US equivalent. And on Ether, it's 100 Ether, which is around 25,000 USD equivalent.
Yeah, so you kind of want to, you're more retail focused because you're a little bit more diversified. I see you have like no limits on when I can deposit or withdraw. So I could imagine a huge withdrawal could really affect you. So maybe by being more retail, keeping that amounts down, you're more diversified against that.
That's a great point, and it's another factor of consideration from a risk management perspective. Yeah. We benefit from diversification both in terms of our depositor base and in terms of our borrowing base. The other factor is that we plan on launching additional products in the future. So from a corporate business development perspective at BlockFi, we benefit from having more users on the platform, because when we launch things in the future, like the ability to earn interest on your Bitcoin in dollars, or a crypto rewards credit card, having more people on our platform that could also potentially use those subsequent products is really valuable to us.
Yeah, makes sense. Makes sense. I want to get into that a little bit more later, but I want to ask one other question. So again, back onto the velocity of money, having $1 do multiple jobs. I talk about like a whole life insurance vehicle where I could make 8%, borrow against it 4, or a house where I could borrow back out at 4, but I'm making 10. So there's that arbitrage spread. Now I notice you pay the difference of what I can borrow against or what I can earn. There's about a 2% spread. Is there an arbitrage play, or no, I have to choose one or the other?
There's not as clear cut of an arbitrage play as in the examples that you describe. And the primary reason is that it's two different currencies. So we've got Bitcoin and dollars in the BlockFi example versus just dollars in the example of a house where you're making other investments. And the other reason is that when you're borrowing dollars from BlockFi, the collateral that you're using to secure those dollars that you're borrowing is not still earning interest. But there are arbitrage opportunities that are created on the fact that we're paying interest on crypto, and on the fact that you can get access to USD from a velocity of money perspective. Got
it. Okay, good. Now we'll get into some tough questions.
Great.
The stuff that people should hopefully be asking, and like you said, you saw some of my videos, and I wanted to kind of talk about. I talked about the lending aspect, and I said, hey, obviously there's risk. Everything in life has risk, right? If I do something, there's risk. If I don't do something, there's risk. And so what are, I guess, some of the risks that people would have obviously would be giving their money up. Now, as you mentioned, giving it to a bank, there's FDIC insurance because they're holding my deposits. Now, there are risks. The risks are very low, which is why the interest rate is super low. Obviously, now I'm going to get a higher interest rate return, but I would imagine there's higher risks. Can you talk about some of those that maybe people should be aware of, and what you do to kind of de-risk that?
Yeah, absolutely. So at a high level, you can bucket the risks into 3 separate categories. So there's fraud risk, security risk, and credit risk. The fraud risk is anyone who's followed crypto for a while might be familiar with like the BitConnect. For better or worse, there have been some shady characters in the cryptocurrency industry. There have been some scams, and there have been quite a few of those scams that had to do with this concept of like earn 1% interest per day, that type of thing.
If it sounds too good to be true, it probably is, right?
If it sounds too good to be true, it absolutely is. We're definitely, I can guarantee that there's a 0% risk that we are in that bucket, and the way that you can verify that is by simply looking at the types of investors and backers that we have for the company, groups like Fidelity and Galaxy Digital and other noteworthy kind of venture institutional type investors who obviously put us through a ton of diligence before they make any of those investments. Second risk, security risk. We mitigate the security risk largely via a partnership with Gemini. So the other thing you have to be cognizant of in the cryptocurrency industry is not having the private keys, hacked or stolen from yourself or the entity that you're storing them with. Gemini is our custodial partner. They have insurance on all of the assets that are held on their platform. They were the first custodian to get a SOC 2 audit, which is like a bank level security audit, and they have a perfect track record with 0 losses in terms of custodying billions of dollars of crypto for many years now. The last risk is probably the one that we could do a whole separate 30-minute or an hour-long show on if we wanted to really get into the weeds of it, but it's that credit risk part.
That's the big one.
And there's 2 components to the credit risk. So there's the counterparty risk that you're taking to BlockFi. So, is BlockFi well capitalized enough to continue operating its business? Does BlockFi have the proper safeguards and separations of capital between our funds and our customers' funds? That's one part of the risk. And the other part of the credit risk is the pool of borrowers that we're lending the crypto to. Who are they? How well capitalized are they? How much collateral are they posting to BlockFi? And so just to touch on a couple quick details on both of those points, and then we can go deeper in it or switch to another topic, whatever you prefer. In terms of the BlockFi side, so we have a number of operational and financial rails in place at the company that would raise flags or prevent any one person from taking actions that would blur the line between our customers' funds and our own corporate, equity capital. Mm-hmm. And then in terms of who the pool of borrowers that we're lending to are, we have a team that's headed up by a former managing director of prime brokerage at Bank of America Merrill Lynch, who lent for 15 plus years there and never lost a penny, including throughout 2008 and 2009. And we onboard every borrower through both a counterparty credit risk framework and then a required collateralization level. So for example, if a borrower of cryptocurrency doesn't have a minimum net worth of, as a general rule, 50 million, then we would always require over collateralization, meaning we would lend them $1 million of Bitcoin, but they give us $1.25 million in USD or stablecoin. And then in that scenario where we're over collateralized with dollars, we're using the same risk management system that's been operational for the USD lending side of our product stack since January of 2018, and we've in either product never had a late payment or a loss or any legal issues. So our performance has been perfect to date. I'll pause there, but I'm happy to drill in deeper.
So it sounds like the big risk on that would be if the market were to crash so fast that you couldn't cover the collateral, that could be a problem. Now, you mentioned earlier that you really want to focus on the main coins that have a lot of liquidity. We did see recently with Poloniex, they had a problem, right, where one of their coins had no liquidity and they lost a lot of money. And then they basically socialized those losses and made everyone take like a 16% haircut. But you don't really have that because you're working on more highly collateral or high liquidity coins. But I guess that would be one risk, right?
That's absolutely one risk. We actually evaluated lending on Poloniex as a potential channel for us, and couldn't get comfortable with some of the assets that they had on there. So fortunately, we got that one right. And from a capital stack perspective, right now, our equity and any employee contributions into the interest account are junior to our customers' funds. So as it stands today, we would kind of close the doors at BlockFi before we socialized any losses into our pool of customer funds that are in the interest account.
So if, for example, you had done the Poloniex deal, you had taken a 16% haircut, you're saying BlockFi would be ready to take that loss as opposed to trying to push it into everybody else.
Correct. We would have eaten it. And to give you another data point, which would be helpful. So like, even if we were lending on Poloniex, that exposure would be maximum 5% of our total lending activity. So the haircut relative to BlockFi's pool of capital that it's lending in aggregate would be 5% times 16%. I can't do that math in my head. And then yes, we would take that loss out of our equity capital rather than socialize it.
Got it. Now, I'm guessing the funds are commingled, so there's really no separation there. Is that correct?
Correct. Everything's commingled once it hits Gemini. The way the system works is that we create a unique deposit address that maps one-to-one with each one of our customers. We monitor the blockchain to record activity into any one customer's account. But when crypto is sent to a customer's unique address, it's instantly swept into a master custodial account with Gemini and then into cold storage per their treasury management function.
Is there some sort of like UCC filing or something that shows that I have something there in case creditors were to come in and shut down or something like that?
Ooh, there's not a UCC filing when you deposit into the interest account. No.
Okay. But you did say that all the lenders are senior to the other debt. So in event of some sort of a liquidation, the senior would get the money first, I guess, right?
Correct.
Okay. Well, that's at least good. But good stuff there. Now, those are the tough questions. I appreciate you for going into that. Like you said, we could probably dig in deeper, but I think that's pretty good. I'm curious about the future of BlockFi. So I've seen other platforms like Nexo, for example, right, returning profits back to token holders. Celsius has a token. You guys don't have a token. Let's maybe talk about the future. Is there some sort of profit sharing down the road, or token, or something like that?
Highly unlikely that we'll ever have a token. If we did do something similar to that, it would be more like offering access to a subsequent equity funding round on a equity crowdfunding platform like a Bank to the Future, like what Kraken just did, or some of the others like Seed Invest, which is owned by Circle. So no token. We think that value should just be passed through to offering the best rates. What you'll see from us in terms of platform development is continued improvement on the products that we already have in terms of features and functionality and visualizations. And then we plan on launching 2 additional products over the next year. The first is the ability to kind of do asset conversion on our platform. So for example, selecting the asset that you want to earn your interest in regardless of what asset you've deposited. So for example, you've deposited Bitcoin, but you want to earn interest every month in dollars, or the other way around. And also just being able to manage a targeted portfolio allocation within our platform versus having to move assets off of our platform to exchange them for other assets somewhere else. And then in the first half of next year, we expect to launch a Bitcoin rewards credit card where just swap airline miles or normal cash back on a credit card out for 1.5% cash back in Bitcoin based on how much you're spending on the card. So that's kind of our immediate roadmap that we're focused on.
Very cool. Very cool. What do you think about regulations and how that puts risk for the company? BlockFi risk, not creditor risk, as you said. So that's a fourth one that we didn't cover, but regulatory risk. So for those that have been living under a rock the last 24 hours, Facebook coin announced they're coming out, and now several big governments are saying, no, you're not, right? Right, or something like that.
Yeah.
What do you think about that, and what kind of risk does that pose for you or the industry?
Yeah, so I think we've taken a very different approach, for example, than others like Celsius and Nexo, who you mentioned. We came from the fintech world, started the company in the summer of 2017 in the middle of the ICO boom, and one of the reasons, and there were multiple, but one of the reasons why we elected to not finance the company's operations by conducting a token sale was we felt that would put a level of regulatory uncertainty and regulatory risk on the company that wasn't necessarily value add to our users. So the other thing that we did is we've had a KYC and AML policy from day one. We have gotten licenses to operate the lending activities that we're doing in the states that we need them from day one, which, we've got some battle scars from that from back in 2017, like explaining why making someone a loan secured by the value in their Bitcoin wasn't illegal to, the state regulators of California, for example. But we hold lending licenses, we update them, we're sharing information with the necessary regulators. So we sleep pretty well at night in terms of the regulatory risk, frankly. But I think for the sector overall,
let's talk about the sector overall.
Yeah, for the sector overall, I feel like Bitcoin's in a great spot. I feel like Ethereum's in a great spot, at least in the U.S. market. Maybe in other markets, especially markets that have weaker currencies, they could be a bit more at risk. And I think governments are really not going to like Libra coin. And the reason is that like with Bitcoin and Ethereum, they're really not, at least today, trying to go at the core of what a government currency is going after, or at least they're not successful enough at it yet for a major government to think that it's a risk to them.
Right.
Whereas Libra coin is basically designed the same way as like the special drawing rights of the IMF, where it's like if something were to happen, the IMF would have the ability to take the basket of currencies that it's holding and issue a new currency. And that's basically what Facebook is trying to do. And Facebook is already on somewhat shaky ground because of the privacy and data stuff. So I think that one's going to get, I think it's going to have a lot of governmental challenges. It's obviously not going to be decentralized from day one, which is another problem that it faces. But I think that for Bitcoin, it's going to be on a great path. I think good things are going to continue to happen in the US and other major markets. I think there's going to be this snowball effect that has continued even throughout the bear market of institutional adoption, which ultimately, at some point in the future will lead to government adoption in some way, shape, or form. And you'll have a central bank, a small one initially, but you'll have a central bank putting Bitcoin on its balance sheet. And then that's going to create this massive snowball. So, I'm really bullish on Bitcoin.
Yeah, I agree. It's interesting just to see the shakeup in that. And hopefully what I hope is that with the government's wanting to crack down on Libra coin, it doesn't, some of that regulatory stuff doesn't spill over into bigger crypto. For that, we'll just have to wait and see. But it's just good to have that conversation. But I think, what I believe is that volatility is like the difference of perception and reality. So in 2017, everybody perceived Bitcoin and crypto to be way higher than it really was. The reality was the technology wasn't there. And then of course it crashed, and now perception is here. But the reality is it's gotten way better, right? Now we have more scaling solutions and more adoption. And I think, and then I think that perception needs to come back up, which we'll see that price come up, which it already is. And I think options like what BlockFi is providing is going to help that. Because it allows people an option without having to sell. And so they can stay in, they can hodl, and ultimately that should be good for the ecosystem, right?
Yeah, and I mean, I can tell you just, firsthand, since we've launched the ability to earn 6% interest on your Bitcoin, we've had people come to us who don't own Bitcoin yet. And they'll say like, I'm not sure exactly how Bitcoin works, but I know that I'm not earning 6% interest on on other assets that I hold. So can I buy some through you? And right now we say, well, actually you should go to one of these other places to buy it and then send it over to us. But it's a core part of functionality, and it might not be for everyone. It might not meet everyone's risk tolerance, but it's definitely a natural evolution of the ecosystem. I certainly love it. I was the first customer of earning interest on my Bitcoin, and a lot of the products that we're building are based on things that I and others here on our team want to use. So we're excited about it.
Yeah, well, like you said when you started, right? Your research kind of lines up with what I talk about, and it's about having $1 do multiple jobs, and this is the perfect way to do that. So I think it's great for the ecosystem overall. Pleasure to have you on. A really good conversation. I love that we kind of share some investment ideas, kind of the same there, and that's really cool. So where would people go to learn more about BlockFi or to follow you?
Yeah, sure. So our website is blockfi.com. You can find me on Twitter. I'm BlockFi Zach. And if you want to shoot me an email, my email is zac@blockfi.com. We have chat on our website. We've got a phone number on our website. We've got a bunch of really smart people on the team that are happy to take questions or just hear people's feedback. So don't hesitate to reach out.
So you're not hard to find.
Not hard to find.
Great. All right. Well, that's it for today. Thanks for joining in.
Thanks for having me. I hope to meet you in person next week, Mark.